Once you've decided your cannabis business is ready to go public, another major decision looms. How will you go public? Currently, there are three paths to becoming a public company: an IPO, initial public offering, RTO, reverse takeover, or being acquired by a SPAC, special purpose acquisition company. In the following, we'll examine the details and pros and cons of the first two options and address SPACs in a later video. Before we dive in, be sure to like, subscribe, and turn on notifications for more cannabis news and updates. In mainstream industries, the best known and most common path to going public is the IPO. In an IPO, a private company is owned in full by a small number of shareholders, typically the founder, early investors, and leadership team. By going public, you convert the ownership shares of your company into public shares that can be purchased by public investors, including institutional investors and retail investors. During the IPO, the value of shares are priced during the process of underwriting due diligence, where a team of legal and financial experts will value your operation. Let's say your company is worth $300 million and you issue 3 million shares. That would mean that each share will be worth $100. Your original shareholders will continue to own many of the shares, and the big difference comes in the fact that these shares will now have a real market value. The rest of the shares are then sold to public investors, which result in your company raising a significant amount of capital. In an RTO, instead of issuing an IPO, which can be very costly and time-consuming, you identify an already public company, purchase a controlling stake in that company, and effectively take over their listing. This transaction is primarily possible due to the existence of shell corporations that currently exist on many exchanges. Shell corporations are formerly operational companies that have little to no recent activity or assets. As a result of taking over a pre-existing listing, you skip over many of the regulatory requirements of an IPO. Some of the downsides of an RTO is that you typically give up significant capital and/or shares of your company in acquiring the shell company, and you also do not necessarily raise the initial capital amount that comes with an IPO. IPOs and RTOs both have advantages and disadvantages, and choosing the right path will largely depend on the operational and financial specifics and long-term plans of your cannabis company. Other factors like current market timing, market conditions, and regulatory requirements can also have a major impact on your decision making. Following are some key considerations and commentary for both options. Time to market. RTO can be executed successfully in a matter of weeks or months, whereas an IPO can take 6 months to a year in some circumstances. In an IPO, the timing of the event is a major consideration. Stock dilution. You have greater control on the amount and percentage of stocks issued to public investors through an IPO. In an RTO, you are likely to give up a large percentage to the shell company's owners. Liabilities. You have a fresh start with an IPO, versus with an RTO, you may have to manage previous liabilities and debts attached to the shell company. Due diligence. With an RTO, you save time and money with significantly less regulatory and underwriting due diligence. With an IPO, you undergo much more extensive due diligence. However, it may translate to greater market confidence and a higher valuation and stock price. Stigma. There has been a lingering negative around RTOs in mainstream industries, but an IPO is typically a widely celebrated achievement. An IPO earns community press and accolades when executed well. Costs. The primary cost of the RTO will be acquiring the shell company and preparing to operate as a public company. With an IPO, the amount of marketing, due diligence, and financial and operational preparation can be very costly. Influence of external factors. An RTO is much less influenced by outside factors, whereas the success of an IPO can be largely determined by outside factors. An RTO has a greater likelihood of completion when many IPOs are delayed due to unfavorable market conditions. Capital potential. IPOs commonly raise significant amounts of capital in the initial issuance. In an RTO, you miss out on the initial raise, but you're faster to market in trading public shares. Both options for taking your cannabis company public are valid, and the right choice will depend on your leadership team's experience and long-term goals. Weighing all the pros and cons, determining the appropriate timing, and performing the financial and operational upkeep is very important for both paths. Working with experienced accounting, financial, and legal teams are essential to securing the success of your go-public transaction. GreenGrowth CPAs is a boutique cannabis accounting firm with real-life experience preparing cannabis companies to go public and executing optimal IPOs and RTOs. We are licensed to serve as auditors on both sides of the border and ease your entry into public markets. If you're ready to go public or start considering a go public transaction, schedule a consultation with our team by visiting greengrowthcpas.com or give us a call at 1-800-674-9050. I'm Chris Ryan, and as always, it is my pleasure to bring you the cannabis news.
Thank you so much for your time. We hope this information has been helpful. If you have any questions or want more information, please leave us a comment below. And be sure to like this video and give us a follow to learn more about the cannabis industry.